Welcome back to AlgoBot, the channel where we break down automated trading strategies for MetaTrader 5, one expert advisor at a time. I'm your host here at AlgoBot, and today we're exploring a strategy called Winsorized Momentum Trend. This is a trend-following system built on robust statistics. Instead of trusting raw momentum, it measures directional pressure with a clipped, outlier-resistant drift, and then it looks to enter on pullbacks to a fast-moving average. By the end of this video, you'll understand how it reads the trend, how it times its entries, and how it manages risk with an ATR-based stop and target. Let's dive in. So what exactly does this expert advisor do? At its heart, Winsorized Momentum Trend is a trend-following strategy, but the way it defines a trend is where the interesting idea lies. A common approach to momentum is to take the current close and subtract the close from a number of bars ago, or to read the slope of a moving average. The trouble is that a single violent candle, a news spike, or a stop run can dominate that reading and paint a trend that isn't really there. This strategy tackles that problem head-on with a technique borrowed from robust statistics called winsorization. Rather than using the average return and the standard deviation, both of which are easily distorted by outliers, it uses the median return as a robust center and the median absolute deviation as a robust stand-in for volatility. Every bar-to-bar return that sits far outside a defined band is pulled back to the edge of that band, so no single freak candle can carry more weight than a normal one. The returns are then summed into a clean net displacement and divided by ATR, giving a scale-free reading the code calls the clean drift, measured in ATRs. Because the drift is deliberately blind to extreme spikes, it tends to flip direction only on a genuine change of regime, not on one dramatic candle that usually snaps back. This makes it well-suited to liquid, trending instruments. The developer notes describe it as designed with major foreign exchange pairs and metals in mind, on time frames from 15 minutes up to 1 hour, though the time frame is never hard-coded and simply follows whatever chart you attach it to. In terms of the trader it fits, this is educational tooling for someone who is curious about systematic, rules-based trend following and who wants to see how robust statistics can be applied to filter market noise. Remember, everything here is for learning purposes only. Trading involves real risk, and losses are part of the process. Let's walk through the logic step by step. On each newly closed bar, the strategy rebuilds its trend gauge from scratch. First, it collects the last 20 bar-to-bar returns, controlled by the MomentumPeriod parameter. Second, it finds the median of those returns as a robust center and the median absolute deviation as a robust measure of spread. Scaling that deviation by 1.4826 turns it into a dependable stand-in for the standard deviation, but one that is not inflated by the very spikes we want to ignore. Third, it winsorizes. Every return that falls outside the band, defined as the median plus or minus the Windsor multiplier times that robust sigma, is clipped back to the edge of the band. No bar is deleted, each still votes, but an extreme move counts no more than a move at the edge of the band. Fourth, it sums these clipped returns into a robust net displacement and divides that by ATR. The result is the clean drift, expressed in ATRs, comparable across symbols and time frames. Now the trading rules. For a long, the strategy requires two things together. The clean drift must be at or above the trend threshold, which by default is 0.75 ATRs, confirming a robust uptrend. And price must have dipped to the fast EMA on the prior bar and then reclaimed it on the current close. In other words, it buys the dip as the trend resumes, rather than chasing a move that has already run. The short side is a mirror image. The clean drift must be at or below the negative threshold, confirming a robust downtrend, and price must have popped up to the fast EMA and then lost it on the close. That's selling the rip within a falling market. Risk management works on two levels. A live trade is closed the moment the clean drift crosses back through zero against the position, because that means the robust regime itself has turned. On top of that, every trade carries a protective ATR stop, 2 times ATR by default, and a wider ATR target, 3.5 times ATR, letting a clean trend leg run, while capping the loss if price reverses hard before the drift flips. The strategy holds only one position at a time per magic number, and an optional spread filter blocks entries when trading costs are too high. Let's read the actual meta editor code on screen. At the top are the input parameters you can adjust in the strategy tester. The momentum period sets how many returns define the drift window. WinsorK is the half-width of the clipping band in robust sigmas. The trend threshold is the minimum clean drift, in ATRs, needed to call something a real trend. The fast EMA period is the moving average the pullback must reclaim, and the ATR period both scales the drift and sizes the stop and target through the two ATR multipliers. Now the long block. The condition reads, if the drift in ATRs is at or above the trend threshold, and the previous close was at or below the fast EMA, and the last close is now above it. That's a confirmed robust uptrend plus a dip that has just reclaimed the moving average. When it's satisfied, the entry price is the ask, the stop is placed the ATR stop multiple below entry, the target the ATR target multiple above, and the EA calls trade.buy with those levels. The short block is the exact mirror. If the drift is at or below the negative threshold, the previous close was at or above the EMA, and the last close is now below it, that's a robust downtrend with a failed pop. Entry is the bid, the stop sits the ATR multiple above entry, the target sits below, and the EA calls trade.sell. Both sides only fire when the computed stop distance is valid. Let's bring the whole idea to life with this illustration. On the price chart, you can see the blue fast EMA hugging the candles. And in the panel below is the gold line, our clean drift measured in ATRs, with the uptrend threshold at 0.75, a zero line in the middle, and the downtrend threshold at minus 0.75. Watch the opening candles. Price steps higher, one modest bar after another, and notice what the drift is doing underneath. It climbs steadily and, by the third candle, pushes above the green uptrend threshold. That's the strategy confirming a robust uptrend, built from many ordinary bars leaning the same way rather than one dramatic spike. Now the fourth candle pulls back. Price dips down and closes right at the fast EMA, sitting at or below the blue line. This is the setup the strategy waits for. It doesn't chase strength, it wants a dip inside a healthy trend. On the very next candle, price snaps back up and closes above the EMA, reclaiming it while the drift is still comfortably above the threshold. Both conditions are met, and you can see the buy entry marker appear right there. The protective stop is placed a defined ATR distance below, and the take profit sits a wider ATR distance above, roughly a 1.75 to 1 reward to risk framing, since the target is 3.5 ATRs against a 2 ATR stop. From there, the trend does the work. Price advances through the next few candles. The drift stays elevated, and by the 8th candle, price reaches the take profit target and the long trade is booked. Notice the strategy: simply let the clean leg run to its target rather than exiting early. Now the character of the market changes. After the peak, candles begin closing lower and the gold drift line rolls over. It falls back through zero and keeps sliding, and by the 12th candle it has pushed below the red downtrend threshold at minus 0.75. The strategy now recognizes a robust downtrend. Watch the mirror image of our earlier setup. On the 11th candle, price pops up and touches the fast EMA, closing at or above the blue line, a rip within a falling market. On the next candle, price rejects lower and closes back below the EMA while the drift sits under the negative threshold. Both short conditions align, and the sell entry marker appears. This time the stop is set a defined ATR distance above entry, and the take profit target sits below. Price then works its way down over the following candles. The drift stays firmly negative, and by the final candle it reaches the take profit target and the short trade is complete. Had the drift instead crossed back up through zero at any point, the strategy would have closed the position immediately, because that zero cross is its signal that the robust regime has turned against the trade. That's the full cycle. A robust trend confirmed by the clipped drift, a patient pullback entry that reclaims or loses the fast EMA, and a disciplined exit driven either by the drift flipping through zero or by the ATR stop and target. The winsorization is the quiet hero here, keeping the drift honest so that a single outlier candle can't fake a trend that isn't really there. And that brings us to the end of our look at Winsorized Momentum Trend. We covered how it builds a clean, outlier-resistant drift using the median and the median absolute deviation, how it normalizes that drift by ATR, and how it enters on pullbacks that reclaim or lose a fast EMA in the direction of the robust trend. We also saw how it exits when the drift crosses back through zero, backed by an ATR stop and target. Remember, this video is educational content only and not financial advice, a recommendation, or a solicitation to trade. Every strategy carries risk, and losses are a normal part of trading. If you found this breakdown helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment telling us which strategy to explore next. You'll find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.